Part 1: Yield Curve. Why the bond market sees recession first. If you want to understand recession risk before it shows up in headlines, you don't start with GDP. You don't start with inflation. You start with the bond market, specifically the yield curve. The yield curve shows interest rates across different maturities of U.S. Treasury bonds, from short-term bills to long-term notes. Under normal conditions, longer maturities offer higher yields. Investors demand compensation for time and uncertainty. This upward-sloping curve reflects a healthy balance between growth expectations, inflation risk, and monetary policy. But when that relationship flips, when short-term yields rise above long-term yields, the curve becomes inverted. This inversion is not random. It is a collective judgment by the bond market that current monetary policy is too tight for future economic conditions. Investors are effectively saying, rates will have to come down later because growth cannot sustain this level of restriction. That is why yield curve inversions have such a strong historical relationship with recessions. Nearly every U.S. recession in modern history was preceded by a yield curve inversion, especially in the 2-year versus 10-year Treasury spread, and the 3-month versus 10-year spread, monitored closely by the Federal Reserve itself. The reason this signal works is simple. The bond market is forward-looking. While economic data tells you what already happened, bond yields reflect expectations about future growth, inflation, and policy. When long-term yields fall below short-term yields, it signals that investors expect weaker growth and lower rates ahead, even if current data still looks strong. But here's the key misunderstanding. The yield curve does not predict the exact timing of a recession. It signals structural stress building beneath the surface. During the inversion phase, economic data often still looks healthy. Employment remains strong. Consumer spending holds up. Asset prices can continue rising. That's because monetary policy affects the economy with long and variable lags. Rate hikes do not stop growth overnight. They work gradually through credit markets, bank balance sheets, and lending behavior. The bond market, however, doesn't wait for confirmation. It prices what's coming next. An inverted yield curve compresses bank margins by making short-term funding more expensive than long-term lending. As a result, banks become more cautious. Credit standards tighten. New loans slow. Long-term investment decisions are delayed or canceled. These effects accumulate quietly, even while headlines remain optimistic and earnings reports still look solid. This is why recessions rarely begin at the moment of inversion. They begin after enough pressure is built inside the financial system. Professional macro investors understand this dynamic. They do not treat yield curve inversion as a reason to panic. They treat it as a warning that the cycle is maturing. Risk is not immediate, but it is rising. The curve doesn't scream, it whispers. And by the time the message becomes obvious in employment data, corporate earnings, or GDP reports, the cycle is already turning. The bond market always moves first. Part 2. The real recession signal. Why risk peaks after the curve normalizes. Most people believe recession risk is highest when the yield curve is inverted. Historically, that's not true. Recession risk tends to peak after the yield curve starts to normalize, not during the inversion itself. This misunderstanding causes many investors to react at the wrong time, selling too early or buying too late. Here's why. When the Federal Reserve tightens policy aggressively, short-term interest rates rise. This pushes short-term Treasury yields above long-term yields, creating a yield curve inversion. At this stage, the economy often continues to function, at least on the surface. Employment remains strong. Consumer spending holds up. Corporate earnings may still look healthy. Financial markets can remain calm, and in some cases, risk assets even continue to rally. But the real damage appears later. High short-term rates act like friction inside the financial system. Borrowing costs rise for households, corporations, and banks. Adjustable rate debt becomes more expensive. Refinancing slows. Credit growth begins to decelerate. Banks, facing higher funding costs and tighter margins, respond by tightening lending standards. Credit becomes harder to access and not just more expensive. As these conditions persist, borrowing costs rise, credit growth slows, lending standards tighten, corporate margins come under pressure. This process is gradual and largely invisible in early-stage economic data. Eventually, something breaks. It might be a credit event. It might be stress in the banking system. It might be a sharp slowdown in hiring or capital investment. That is when the Federal Reserve begins to cut rates. Short-term yields fall quickly in response. Long-term yields fall more slowly, or sometimes barely move at all. The yield curve steepens or uninverts. To many investors, this looks like relief. Rates are coming down, policy is easing. The worst must be over. But historically, this is when recession risk is highest. Central banks do not cut rates because everything is fine. They cut because financial conditions are deteriorating faster than expected. By the time rate cuts begin, the restrictive effects of previous tightening have already worked their way through the economy. This is why many U.S. recessions officially begin after the first Federal Reserve rate cuts, not before. The yield curve captures this sequence with remarkable consistency. Inversion builds stress. Steepening reveals the damage. Understanding this timing is critical. Investors who panic during inversion often exit risk assets too early, missing late cycle upside. Investors who chase risk aggressively during early rate cuts often enter just as economic conditions are weakening. Macro investing is not about reacting to headlines. It is about understanding sequence and context. The yield curve doesn't tell you what will happen tomorrow. It tells you where you are in the cycle. And that awareness is what separates emotional decisions from disciplined positioning. Part 3. Yield curve, liquidity, and Bitcoin. How risk assets really move now. Let's connect the yield curve to liquidity and to Bitcoin. To understand Bitcoin in a macro framework, you must stop thinking in narratives and start thinking in financial conditions. Bitcoin does not trade on GDP growth. It does not wait for strong employment data. It trades on liquidity. When the yield curve is inverted, liquidity conditions are typically tight. Short-term yields are high. Real yields are restrictive. Holding cash becomes attractive and capital gravitates toward short-duration, low-risk instruments. In this environment, risk appetite fades. During this phase, Bitcoin often consolidates or underperforms, not because the technology is broken, and not because adoption has failed, but because capital is scarce. Liquidity always comes first. As long as short-term rates remain elevated and real yields stay positive, financial conditions remain restrictive. Capital preservation dominates, volatility is punished. High beta assets struggle to attract sustained inflows. Now watch the transition. When the Federal Reserve begins cutting rates, short-term yields fall quickly. Long-term yields fall more slowly or sometimes not at all. The yield curve steepens. This steepening does not immediately signal economic strength. It signals that policy is shifting in response to stress. This is usually the phase when economic data looks worst. Recession headlines dominate, corporate earnings weaken, risk sentiment becomes extremely bearish. Paradoxically, this is also when forward-looking assets begin to stabilize. Bitcoin, in particular, tends to respond early to improving liquidity conditions. As rate cuts progress, real yields compress. Holding cash becomes less attractive. Excess liquidity begins searching for asymmetric upside rather than safety. Bitcoin does not need strong economic growth. It needs easier financial conditions. This is why Bitcoin often bottoms before equities, and long before economic recovery becomes visible in traditional data. Equities are tied to earnings and growth expectations. Bitcoin is tied to monetary conditions. The yield curve helps you recognize this transition, not through price action but through structure. The critical questions are: is steepening driven by falling short-term yields? Are real yields declining? Is financial stress peaking rather than expanding? When liquidity stops tightening, markets stop falling. This does not mean immediate upside. Markets often consolidate as capital repositions and confidence slowly returns. But it marks a regime shift. The bond market always moves first. Liquidity follows. Risk assets respond. Retail investors focus on headlines and narratives. Institutional investors track financial conditions. The yield curve sits at the center of that framework. If you want to understand Bitcoin in a macro cycle, don't follow noise. Don't chase stories. Follow liquidity. And to follow liquidity, follow the curve. Thank you for watching. What's your take on today's market? Share in the comments below. If this video helped you understand market cycles, like and subscribe for more insights from Macro Cycle Lab. See you in the next video.